Jeremy Hale is currently global macro strategist at Citigroup, joins me from their offices in London now. Thanks very much for speaking to us, Jeremy. So what are the prospects for risky assets as we head towards the end of this year and early next year?
We're still very worried about risky assets, equities, credit, commodities, and so on. The main thing that we think that the markets are still responding to is a substantial downshift in growth expectations. The market was very, very complacent and still is in a sense. I mean, consensus forecasts, in our view, are still way too high. The probabilities of the US and Eurozone slipping into recession have increased significantly. And while they may not be, that may not be a definite just now, I think that the market is massively underestimating that risk.
So what could improve the scenarios, if you like, for growth assets? What do you want to hear? What do investors really want to hear from President Barack Obama on Thursday?
Well, I mean, it's tricky. What investors would ideally like would be a short-term stimulus, certainly an extension of the payroll tax cuts, some other stimulus to help both housing and the labour market, but something that's not going to cost anything on the fiscal side in the long term, because the risks are that if there appears to be a more sort of sustained fiscal stimulus at the current level of US debt and deficit, someone like S&P could come back and downgrade the US another notch. So, it's tricky. They need a short-term stimulus without a long-term cost.
And very difficult to strike that balance, isn't it? Because I suppose other economists would argue that if you didn't go far enough in extending stimulus and quantitative easing, well, then it simply wouldn't be effective.
Yes, I mean, I think the scope for using monetary policy, to be honest, is somewhat greater than for using fiscal policy. But even there are constraints on the Fed's scope for action. I mean, they seem pretty penned in just now. I think perhaps a real sort of quantitative easing, writing a check against monetary financing is something that in theory would work, but politically, in practical terms, it's very difficult for the Fed to push that through.
It's interesting because actually many investors that I've spoken to have said they would like to see more on the fiscal side when it comes to investment and job creation programs in infrastructure. You're saying actually there are severe constraints when it comes to this kind of policy. Why? What do you mean specifically?
I mean, I have some sympathy for the point of view that in the short term you could use a fiscal stimulus, particularly if it was monetarily financed. You didn't issue bonds, you just sold the bonds straight to the Fed to support the economy. But the risk is in the longer term that US demographics, US healthcare costs, and just the general level of US debt and high deficits, meaning that in the long term US fiscal policy is totally unsustainable. Markets need to believe that any short-term stimulus will be taken back in the medium term, and the history tends to show that it's very easy to give the short-term stimulus and much harder to take it back in the medium term, because the medium term eventually becomes someone else's short term. It's quite hard then to tighten policy.
How serious are the debt and deficit risks if we do see another round of stimulus either next year or towards the end of this year, indications of it, given that actually the latest downgrade doesn't seem to have done anything to affect demand for US Treasuries, borrowing costs still relatively low?
Yeah, I mean, I think the overall effect of the S&P downgrade was de minimis. It was tiny. Probably had some negative effect on risk assets, really, but nothing in the Treasury market. I mean, the reality is people have been too obsessed with supply as an influence on government bond yields, when the truth is we should be looking at the slope of the curve. I mean, there's lots of carry in government bonds, even at these low levels, because short-term interest rates are zero and are going to stay zero for a very long time. So I don't think there will be a particularly negative impact in the bond market. It's probably more likely to come through the currency market. But again, I think there's some doubts as to whether consumers, households, corporates might save a little bit more if they believe that the long-term fiscal position is unsustainable, and therefore monetary policy is more powerful. Just look at what the SNB has done today.
So, and Jeremy, if I can then ask you quickly about your concerns when it comes to Europe. I know that they're centered on political tensions surrounding the EFSF, the Eurozone Emergency Bailout Fund. We do have finance ministers meeting today to discuss Finland's demand for collateral in return for Greek aid. Could these tensions escalate to the point where a second bailout package for Greece is either derailed or delayed?
I think it's inevitable in the end that the Eurozone problems are going to blow up into what will be, in the end, the need for a debt forgiveness for Greece. Whether it's voluntary or involuntary, I think in the end, if you're looking 6 months or so out, it's quite likely that there is a severe haircut on Greek debt.
Yeah, so ultimately it sounds like you're saying, well, the second bailout doesn't make much difference anyway, because many analysts and economists are saying, well, it did very little to alleviate, to ease the debt burden anyway.
I think the problem is democracy. I mean, there's just no desire amongst the voters in the kind of hard northern European countries to bail out what they see as profligate southern European countries. And as long as we operate in democracy, it's going to be very hard for these finance ministers to sort of bail out the southern European countries.
All right, thanks very much indeed. Good to get your thoughts there. Jeremy Hale, Global Macro Strategist at Citigroup Global Markets.